Okay, so the third video for chapter 12, it's about unidentifiable intangibles. That means we will focus on goodwill. So as we introduced, we have two sources for intangible assets. One is internally, one is externally. So if the goodwill, whatever is how it's about product quality or effective marketing or customer relationships. If it's internally developed, then all of this goodwill will expense directly going to expense. So, but you know, goodwill has some features. It cannot be separated from other assets, and also, so the measurement is very difficult. So all internally developed goodwill are expensed as incurred. But if we purchase from external, we need to identify and capitalize this cost. So 4 factors can account for the difference between the value of the company as a whole and the book value of the net assets. So so as we know, because of the requirement of GAAP, some intangible assets will be very undervalued. That means if I want to buy a Starbucks, the trademark or the marketing relationship, it's very valuable, but the balance sheet, the book value cannot measure this intangible assets very well. So that means these intangible assets may be undervalued. So if you buy the whole company, you need to pay more than the book value. And also many assets on the balance sheet amount different from their fair market value, like the land. Especially in China, you know, 20 years ago, the price of real estate is very different from this year or this 5 years. So, but the real estate still recorded as a historical cost. So these assets, the amount will be very much lower than the fair market value. And also some unidentified tangible assets, because they directly go into the expense, didn't appear in the balance sheet. So you need to pay more than the book value from the balance sheet to buy the company. And also some other reasons. Maybe the acquirer want to pay more. That happened, you know. So if this happened, we need to recognize the purchase the goodwill. So the example shows the book value is $145,000 for this company. Fair value is $319,000. So if the price of this transaction is bigger than 390,000, we need to recognize the goodwill. Okay, so Sarah would record the identifiable net assets of the fair value. So the purchase price is $719,000. The fair value, as I just said, is only $319,000. So the purchase price is $400,000 higher than the fair value. That's goodwill. So we debit the cash, accounts receivable, inventory, PPE, property, plant and equipment, trademark, and credit and not payable, and the cash. Then the difference is goodwill. So it's, you know, the amount is calculated by the price minus the fair value of the whole company. Okay, that's easy. And also we need to, because goodwill is goodwill has indefinite usage life, so we need to review impairment at least annually. If the fair value is decreased to its carry value, its book value, we need to recognize the impairment. And the slide shows you some examples of the impairment exist, like a deterioration of general economic conditions or industry market considerations, or some other, or decline of financial performance of the company, or some key personnel passed away or left the company, and so on and so forth. So because goodwill is an unidentifiable tangible and has a indefinite usage life, so we need to recognize impairment of goodwill. And the method to recognize impairment of goodwill is using reporting unit. Reporting unit is, say, an operating unit, operating segment, which is tightly related to the goodwill. You know, goodwill, one feature of goodwill is it cannot be separated from its operating context. So this operating segment is this operating context. So we use the reporting unit as a basis to review if the impairment happened or not. Okay, and then if a qualitative assessment indicates that it's more likely than not that the fair value of the reporting unit is less than its carry value, a company must perform the quantitative impairment to see if the fair value is less than the book value. If it's so, we need to recognize the goodwill impairment loss. So fair value minus book value, and then the journalized is a debit impairment loss on goodwill, credit goodwill. So the example shows the fair value as $3.6 million. And now it's the book value is $3.6 million. The fair value is $3 million. So it means the market value is much lower than the book value. So the impairment happened. So we need to calculate the impairment loss is fair value minus book value. in this case is $600,000. And then we generalize this impairment. So debit impairment loss on goodwill, credit goodwill. So if in the following years, say the fair value restored and become say 3.6 million again, according to US GAAP, we cannot restore this value. So after you recognize the impairment, that's all. Then you cannot restore that. Okay? But the international financial report standards will be different. We will discuss in the following slides. Here, another issue is bargain purchase. That means if it's possible that the cash paid for company is less than the fair value of the identified net assets acquired. You know, business is business. Sometimes it will happen. Even though the fair value is say $4 million, but the seller will say, okay, I want to sell this asset, say $1 million. So in this case, in this kind of case, the goodwill is negative. But accounting, from the perspective of accounting, we do not record a negative goodwill. So we will do nothing to journalize this kind of purchase. We just journalize the fair value of the cost. But the acquiring company will recognize a gain on the bargain purchase. It's the fair value minus purchase price, but it's for the acquiring company. And then there is a difference, some differences between the international financial reporting standards and US GAAP. The difference include 3 points, big difference. The first point is IFRS allow company to capitalize more of the cost of internally generated intangible assets. They will have a test like a technological feasibility test. It's called economical and technical feasibility test. So it's like the software development procedure. After the test, the cost will be capitalized. But the IFRS will capitalize more. You can read the textbook to see the detailed difference. And also IFRS allow intangible assets to be revalued to fair value. That means if you recognize the impairment for intangible assets, after the value restored, you can restore the value again. But US GAAP cannot do that. Okay? And then for all intangible assets other than goodwill, IFRS allow an impairment loss to be reversed if the value is recovered. As I just stated, the impairment can be restored, recovered. If in general, the IFRS need more professional judgment because it gives more space to recognize the fair value and the volatility of the fair value. So that's intangible assets. So in general, in conclusion, in this chapter, we need to understand the category of intangible assets. And based on the category feature, we recognize different category intangibles in different way and report intangible different categories in a different technical treatment. So we need to have a very good understanding about the feature of different categories. But the very big difference is one is from the external one, the other is from internal. We will capitalize the intangible assets from external immediately and amortize if it has a definite usage life, we will amortize the cost in the following usage year. But for most internally acquired intangible assets, most of the costs go into expense directly, okay? But for the details, you need to have a review of their textbook and complete your homework, and good luck. Thank you.